Morning, everybody. How's everybody doing today? Good. Hope you guys are enjoying the Crittenden conference. Our topic today is buying to maximize yield. Obviously, everybody in this room has that objective to always maximize the yield on their investment. That goes beyond just buying an asset. So we're going to talk about several points today that we can discuss on how some of these guys are maximizing the yield. We're going to be discussing purchasing smart in today's market, what to look for and what to avoid. We're going to be discussing how an investor defines a true value-add deal and where they're adding the most value in investment strategy in today's market. What debt structures are best suited for these types of value-add opportunities. And then we'll finish up with managing to achieve higher yields. Sitting with me today are some of the best in the business. I'm honored and humbled to be sitting with some of these, actually all the panelists. Next to me is James Rastello, Tradewind.
Good morning, everybody. I am with Tradewind Properties. We are a small Houston-based multifamily shop focused only on the state of Texas. We operate predominantly in the big metros, so Houston, Dallas, Austin, San Antonio, focusing on buying apartments and then selling them for more than we pay for them. That's what we do. To date, we've got about 3,000 units all in Texas. And since the beginning of this cycle, and more or less when we founded our company in 2012, we've cycled through about 7,000 units across the state.
Thank you, James. Next to him is NoahMiller of Pensam.
Sure. Thanks, John. I appreciate everyone who's come out today and the panelists. It's exciting to be here. My name is NoahMiller. I'm Vice President of Acquisitions and Finance for Pensam Capital. We're a private Miami-based group. We currently have investments in around 30,000 apartment units, split between a couple buckets of capital. One is our owner-operator side, where we currently have a portfolio of about 15,000 units. This is typical garden-style Class A and B product throughout the United States. We're in about 25 markets at the moment. In addition, we have a preferred equity / mezzanine bucket where we've invested in an additional 15,000 units or so. And then third, we have a bridge loan program. So we're really playing up and down the capital stack all across the multifamily spectrum. And also, like my friend James, we also like to buy and sell at higher prices.
Next is Eric Silverman, founder and managing director of Eastham Capital.
Hi, good morning. My name is Eric Silverman, and my company is Eastham Capital. You know, I just looking at the panel here, we're also trying to maximize speakers on the panel.
That's right.
So in addition to learning about maximizing yield, we're going to maximize speakers. My company, Eastham, is a fund, a series of funds. All we do is buy apartments, typically suburban garden-style apartments, typically built in the 70s or 80s. Texas is by far our biggest market. We joint venture with great local operators in every market. And we just raised a new fund, so we got lots of money. So if you're a operator looking to buy deals, please show us your deals, and maybe we'll start another partnership. Thanks.
Next to him is Deuillet, Senior Vice President of CBRE.
So I guess I'm the designated broker up here. So with the tie. That's right, with the tie. That's smart. So grew up here in Dallas. Been doing B and C multifamily properties for about 18 years. On a team of 6 that we pretty much cover A, B, and C product. And really, my team's focus has been strictly value add, older vintage deal, and allowing my clients to buy low and then sell high and make money.
Thank you, Chris. And last is Carlos Paz, founder of CONTI.
Thank you, everyone, for being here. It has been raining a lot in Dallas, and thank you to the panel as well. My company is a CONTI organization located here in Dallas, Texas. We're pretty much a very boring company. We buy. We don't like to sell. We avoid selling. We think there's an opportunity to optimize value. So occasionally we sell, but not as often. Our main core is really kind of the culture that we have in the company, our people in the process, which we happen to be in multifamily, and we love what we do.
Thank you, Carlos. My name is John Barker. I'm the founding principal of 180 Multifamily Capital and co-founder of 180 Multifamily Management. We're a locally based multifamily company primarily focusing on the acquisition and management of B and C quality assets. We were created in 2009. Historically, we bought tremendously distressed really cruddy properties, and we've turned them around. Now our objective is really looking at more B, C+, B plus assets. We're also looking at other markets outside of Dallas-Fort Worth, throughout Texas, and even in Oklahoma City. We are a fully internal company, meaning that we do everything from locating assets, due diligence, acquisitions, renovation, and management. So I think that is, in essence, what's helped our firm really maximize yields by keeping everything inside. So let's go ahead and jump into it, guys, and we'll see what we can do. So let's just jump to the gun here. So purchasing smart in today's competitive market is our first topic. I'm going to open up this first question to everyone, and so what are some of the most impacting changes you are seeing in today's market when looking to acquire an asset?
I guess I'll start. So I think the first thing is competition. There has been an influx of investors over the last probably 5 or 6 years that are completely drowning the market almost, and I don't say this to scare people, I say it to caution people. We've been buying, again, multifamily for now about 10 years, and I'd say 3 or 4 years ago, there was a solid group of buyers, and everyone knew them, and everyone knew who their capital was, and that they could perform. Now, when you look at the buyer pool out there, you don't know who these guys are. And it's a little bit scary, especially for experienced buyers like most of us, because when we're putting in bids, we're going up against guys who are putting crazy money hard day one, and a seller is saying, listen, we don't know who these guys are, we've never heard of them, but they're also offering $1 million hard day one with $1 million purchase price higher. So experienced guys who are a little more patient, I think, are getting outbid in that process. So I think the first thing we're seeing is competition. Obviously, then there's the threat of raising interest rates. If you're long term, it's probably not as bad. If you're short term, that's something you have to be a little worried about.
I couldn't agree more. I mean, I've actually got outbid in the last 8 offers I put in, so that's not good.
Yeah, the only other thing I would add on that, and the addition, I mean, all the capital in the market has led to asset prices going up tremendously because of competition. And furthermore, when we're looking at the typical value-add deal, the 70s, the 80s, and even the early 90s, now we're looking at assets that have been rehabbed 2 times, 3 times, 4 times. We're on the 4th generation of renovation. What's there really left to do, and what's the potential incremental upside? And so that's what's left to understand, and you're paying top dollar for it. So that's the other thing we look at quite a bit when in this market.
I'll follow in with, in Texas, we're seeing a lot of increases in real estate taxes, other places in the country too, but taxes and other operating costs are part of what's driving rents higher. So it's great to think about rising rents, and while we probably aren't going to continue at 6 or 8 or 10% rent increases, it's reasonable to assume that you can have some rent increases, but we're putting a lot of that money back into operating properties. So the profits aren't necessarily getting better. Maybe a little better, but not a lot better. I will add just on that, one of the things that's very positive, if you're going after the lower end properties where you're renting to people making, let's say, $30,000 to $50,000 a year, the tax law change is just starting to hit people's paychecks. And if you're making, let's say, $30,000 to $50,000 a year, you're probably you're taking home $100 to $200 more a month. And that buffer, that increased amount of take-home pay is really making it, I'm not going to say easy to raise rents a lot, but easier to raise rents a little. So that's an important thing to watch.
James, what do you... Go ahead, I'm sorry, Carlos. Sorry.
No, sorry, John. Yeah, it's a very competitive market. I think number one is what's your business plan? I mean, there's a saying, right? Hope is not a strategy. So what's the business plan? It's very clear. You think about selling year 5 or year 3, what can happen? I think that be careful about the market. And the saying that you have in your office, right? The good thing about Excel, everything works in Excel. The bad thing about Excel, everything works in Excel. So who the heck is verifying that data? So trust but verify. So that's, there was a good article in the Wall Street Journal saying that buy properties for income, not for appreciation. So you need to look at the property. What am I buying today? Is the property generating income? So sitting on our side as an operator, say, well, we can look at 5 years from now, I'm going to make X. What am I going to make next month or next quarter? So I think that the income has to be something very important. And also, if you look at the way the things that happen in Texas and in Dallas, so Dallas is no longer a tier 2 city, but at the same time, it's not a tier 1. It's not the San Francisco. It's that between. So with being in that position, you see a lot of capital, not only U.S. based, but all over the world, coming to Dallas now. So the competition is much greater. Today we have 400 people per day moving to Dallas, and it's over 1,000 people per day moving to Texas. It's a lot. And to jump on what Eric said here, if you look at the tax change that happened, a lot of the people that are going to be moving from the East Coast and the West Coast, coming south, coming to Texas, coming to Florida, are actually people for higher income. So these people come moving in here, people are making a little bit more money. They're going to create these small jobs, some restaurants, some other business. They're going to be able to support that one. So it's interesting. So more people working, so you can see be able to push more rents.
I'll chime in real quick. A lot of the references here is obviously economic, how the properties operate, taxes, things like that. What I'm also observing in the last 5 or 7 years is that location obviously is important, but what I'm seeing is a lot of regentrification, tear downs, rehabs, sprucing up of properties and locations, at least here in the Metroplex, parts of Fort Worth, infill locations, that 5 years ago, oh my gosh, people would say, I'm not going there, that's, I can't even walk around there, I get shot. And all of a sudden, people are coming in there, developers are looking at it, and all of a sudden everybody's taking a second look at it, and these locations now are prime redevelopment plays, and a lot of people are studying those. So it's not just, hey, I'm following the path of growth, let's go north or in certain directions. They're picking certain pockets inside a given city, and that's, I focus Dallas-Fort Worth, but I know in major metros throughout the nation, it's that way. And so I think a lot of people are now reconsidering location as a key indicator of what to do.
Absolutely. All great points. So when we're looking for assets, James, what are you doing right now as far as being able to locate and find assets that you would pursue? And I guess the second part of that question is, are you really finding really true value-add deals in today's markets?
Now, as everyone's mentioned, it's not getting easier, it's getting harder to find these deals. And the big, in order to find these deals, I think the most important thing is just being relevant in these markets. And it's not, you can't just sit back and wait for deals to come to you. It takes a much more proactive initiative to go out and find them. And because there's so many people chasing them, it's very easy for the brokerage community to sell them, generally speaking. And you want to be in the position to be the first call, not the 400th call after 399 deals said, I don't know about this one. So we're trying to be in front of people, be relevant in our markets as much as possible. And to that point, we turn down the vast majority of our deals. We look at 100, maybe we'll do one. But that said, we did 2 this year, and I think we're very pleased with the 2 that we've done. They're both unique deals, and I think that we'll be able to generate some return on them. But as far as what we're looking and how we're looking, right now, I think in this marketplace, you can't really look at price per pound. It's not a relevant metric. It's kind of meaningless. And if you do, you'd never do any deals because you look back a couple years ago, it's like, well, that was 40 yesterday, and now it's 80. That doesn't make any sense. So if you do that, you're not going to end up doing anything. You got to really focus on cap rates, or at least that's what we've done. And we look at where's the cash flow today, and where is it going to be, and what is our in-place yield, and where can we get that to? And I think that's paramount. Furthermore, what we've got is, we focus on the 4 large cities. In each of those cities, we focus not only on where we want to go, but where we don't want to go. And so we've got our maps, and we circle all the areas, okay, bad, 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 bad. And we go everywhere else that's not in those areas. So at least that gives us a little bit more of a focused approach to where we can be and where we want to be. And the other thing we focused on is, and this has been more of our strategy, is we try to go where the money isn't. There's so much money that's raised, but a lot of times that money is raised for, I can do deals that were built between 1970 and 1980, I can do 9 and 10, I can do core plus. So we try to find things that don't fit inside those baskets, but we can move from outside the basket into the basket, and we think that there's some sort of a cap rate appreciation from doing so. And so when we say when we say out of the basket, we find things that say have major structural issues like foundation issues, or they've got a lura that might be expiring. or they've got phase 2 land. We find there's a lot of money for acquisition, a lot of money for development. There's very little that can do both. And so there's opportunities like that where I think there's still some meat on the bone and opportunities to create some value. And also we think that you know, there's still some very distressed deals out there. They're not as easy to find. We call them train wreck deals. And they still exist, but a lot of times in this market, the deals that are still in train wreck phase, they might still be there forever. And so you got to be particularly careful, but there is some anti-cyclicality to those deals that can make them particularly attractive.
Okay, thank you. Anybody else? As far as what's the strategies to finding deals in today's market?
I think strategy goes back to the old saying, right? It's we're in a relationship business. So I think that something can be said about that one, to the point that, of course, it might sound cliche, but respect everyone you meet and keep the relationships. You never know. The only certainty you have in life is you never know. You never know. That's what, at least that's what I learned. And for us in our company, right, something we define ourselves: focus, relationship, and performance. Know that market, and also it's a numbers game. It's a numbers game. Whichever market you are, know that market a lot. So last year, for instance, in the greater Dallas area, we look at 357 deals. We sent offers in 47, about 7. It's a numbers game. If it's data, look at the data, verify the data. I think that's important. And something, an analysis that we do in our spreadsheets, we do what's called a 5-year rent affordability ratio analysis. So we know by year 4, if you're pushing the rents in, let's say, 5% in that market, what's something very important to us, in the 3-mile range, not the average is very misleading. The median household income has to be above $50,000. We're not going to be below that. So we look by year 4, what's my rent? What's these people come at the door? They can actually, are they making 3.5 the rent amount by year 4? There's no guesswork. Guesswork is risk. So just and feel comfortable the team you have and how can we improve it.
Thank you, Carlos. So let's talk about strategy. So what strategies are you utilizing to compete in still very competitive market? And how are these strategies and how is this competition affecting returns? Eric?
Sure, I like what James said, and to some degree what Carlos said is you got to say no a lot. Basically, good investors spend most of their day saying no, regardless of what they're investing in. So we say no a lot. Right now, competitively, we're finding it very hard to buy in Dallas. We've sold out of everything we bought in Dallas for our strategies. Fort Worth is another market we own a lot, but we're not finding a lot of new stuff that meets our strategies. We're doing more in Houston and San Antonio as it relates to Texas. I think, you know, the idea that I'm working on right now is that we talk about, Noah mentioned all the new players that have come into the market, especially in the last 2-3 years. Many of them, not all, but many of them using crowdfunding sites. So you think about the investor backing those deals, paying high prices. The question is, if you bought in 16 or 17, or you're buying now, are you hitting your year 1 numbers? You know, if you promised your investors 8%, did you deliver them 8%? Because if you didn't pick the right fund manager and you didn't, you know, and you overpaid, and you deliver a 6, that's not great compared to promising an 8. And if things can trend further in the wrong direction, that 6 becomes a 4 or a 2. And you know, my feeling is that by saying no today, it will. I do think there'll be deals coming to the market. Maybe not even this year or next year, but 2020, 2021, where we're 3-4 years into some of these new entrants. Some will do great because they're in the right location or they got the right strategy, and some won't. So, I mean, interest rates are going to go where they're going to go, but you know, deals that aren't performing and not delivering a return, or I know it sounds crazy, but sometimes you actually have to write a check to keep the property. That gets really interesting when you have 75 investors that you've never met all over the country, and you write to them and say, oh, by the way, your 8% yield is now -2, and please send me a check for $452.
Nobody wants to do that. Fellas, let me repeat the question. What's some of the strategies you're doing to compete in what's still a competitive market? How are these trends affecting returns?
I think that goes back to what I said before. You really need to understand the operational side. We see that our DNA as a company is 95% of your operators and 5% in the office. You sit in the office, you look at the trade spreadsheet, but who the heck is at the property? Who's seeing the traffic? What's the trends, right? So by the time you get the financial report and you have a surprise, if you have a surprise, shame on us. It means that you're not doing your job on the operational side. What's the traffic? What are you seeing? Because that can happen, what Eric was saying, right? So if you see that, you put it in a spreadsheet, you think it's a 6 or it's an 8, now it's a 6. Who is doing that management? Who is seeing that trend? So if you see the trend comes in our direction, how can you put the team together and say, hey, listen, I tell the staff all the time, if there's a problem, please let me know now, let's address it together. Don't let me know tomorrow. Tomorrow the problem becomes bigger. And silence is an answer. So if there's a problem, it's right now. So it's just, to me, it boils down to know your market and operations.
Absolutely. Noah, so let's talk about how does your focus change with respect to submarket, asset quality, in a rising pricing environment?
Sure. I think you need to be cognizant of all those. I can tell you, for us, we're a long-term holder, so those affect us a little less than some groups that maybe are only on a 1, 2, 3-year hold. For example, when it comes to rising interest rates, the way we structure our deals is we fix the debt on all of our deals for 10 years. So to be honest, it kind of is in our favor if interest rates rise a little because it almost lessens the buyer pool for us. And we have more of an opportunity to buy because we're locking that money down for 10 years anyway. When it comes to submarkets, we've always had the same perspective, which is we want to be in good, solid submarkets that are strong today and are going to be strong in 5 or 10 years from now. Chris obviously mentioned some gentrification. You see a lot of groups that are quickly jumping into new pockets or submarkets because they think that's the hot area. Some of them will be successful and some of them won't be. Some of them have 1 or 2 developers who happen to be throwing a couple $1 million in that area, but it will fail inevitably. We try not to go into sexy markets that we think are going to blow up. We'd rather go with the slow and steady pockets, and that's why we've done well in the suburbs. Well, one point I want to touch on, and I want to respectfully disagree with James on something. He mentioned that his focus is not so much on price per unit, is on cap rate and yields. We've taken the opposite approach, and it's worked well for us. Reason being, if a cap rate today is, let's say, 5%, that's great, but what happens when you get hit with a huge tax hit, and all of a sudden your cap rate goes down to 4.75, or your insurance costs skyrocket? After Harvey and Irma, our insurance across our portfolio rose almost 20 to 30%. Well, a 5 cap rate then is now a 4.9. So there's so many variables touching on cap rates and yields, and I didn't even mention rents. Look at Austin. Austin rents were growing 8% last year, now they're growing 2%. So I think a cap rate can change quickly. A price per unit is what you pay for it, and that's going to stay. So again, I don't know if there's anything you want to mention on that, but that's kind of been our view.
The only thing I would change, or just caveat, is that when I say cap rate, I say pro forma cap rate. Per our expenses, with the tax adjustments, what's
Sure.
the actual cash that we can believe that we can pay our guys month 1 or year 1?
Sure.
Without a massive rental increase factored in. It's
Understood.
So we want to keep our guys happy.
Good recovery.
Anybody else on that one? All right, so let's go ahead and transition into how to identify true value add opportunities. And what I've seen over the course of the past 24 months is, back in 2009, every deal you saw in the market said REO. Broker had a list of bid stuff, it was stamped with REO, they knew that's what would sell. And so, no offense, Chris. And so now every deal that we see, whether it's marketed or whatever the case, there's always a value add component. And that's what they're marketing and that's what they're selling. But the key is how do you truly identify the real value add deals? And so we'll discuss that a little bit. What does value add mean and look like to you and your organization? We'll start with Noah. We'll start with you.
Sure. I actually think James hit it on the head when he mentioned that every value add today is a value add on someone else's value add, and someone else's value add, and someone else's value add. Sure, you can still find a deal that was built in the 1990s that no one's renovated, but I'm sure you guys have seen it. How many times do you see a 2017 built deal that says value add on it? I mean, it's somewhat become a joke in the community.
Yeah.
So I think one, if you find those deals that are in original condition, go after them. You'll probably do well if the market can handle an increase. But from our perspective, what we've done is we've either done a really small value add program or a really big. And what I mean by that is we focused on a tech package, which has been a huge success for us. Obviously, this won't work on every deal. You're probably not going to be able to go into Arlington and on a C asset and push rents with a tech package. But if you have a property that has a little bit of a younger demographic or higher income levels, you might be able to go in, spend $400, put in our tech package, which is a Nest thermostat, which is a keyless entry, which is USB ports, and you can charge $30 to $40 a month on that. And that's something we've been really successful at. So if you're spending $400, you're doing it in-house, and you're installing it within an hour with your maintenance crew, you get $40 a month, you're at over 100% return in year one on that value add. So that's been a home run for us. On the opposite side, we've gone in and done really heavy value adds. C assets in A locations that we completely take down to the studs, spend $20,000 to $25,000 a door on, and convert that to a B plus property. But again, that has to be a C asset in A location. So we've tried to stay away from the typical value add because we don't think it exists as much anymore, and either go really light or really heavy.
I'll jump in a little bit. I do think there's sometimes a misunderstanding about the use of capital when you buy property. You know, unless it's totally brand new. Almost every property has some deferred maintenance, and we can qualify deferred, but stuff that needs to get done that hasn't been done in the last few years or the last many years. And so I think maybe a misunderstanding about value add is the real true value add is by saying, okay, can we, improve a unit and get, maybe take the tech package concept. Can we put in this tech package for $40, which I need to start doing, for $40, for $400 and get paid back in less than a year? I think we'll do a lot of those in the next few years. But that's not deferred maintenance. And if you don't budget in the deferred maintenance side, or even just the regular maintenance side, I think that's where people get tripped up. So I'd say it's important when you're trying to acquire a deal that you're rational about the capital you're going to put in and understand that it could be hundreds of thousands or even $1 million, depending on the size of the property, that's going to need to go into the property that probably isn't value add. It's probably just stabilization. And if you don't pencil that in and make sure you're doing it, then you're going to have a problem. Probably not in the first year or two, but probably by year 4 or 5, you're going to have a problem.
Absolutely. I'm sorry.
No, go ahead.
Check.
No, I was just going to touch a little bit on, for us, from trying to identify an asset that could be potential value add. Here's a couple things that we look at. And just like Noah said, everything's value add, so just because it says value add doesn't mean it is value add. But we look at it from two sides. One is on the management side, and the other is on the physical asset side. If we get, and on the management side, it really is, where are the comps and where's the property? Because we're never going to be underwriting something that's better than the market. If the market's here and we're here, we love that deal, assuming that it's not priced here. But from the management side, it's look at, is a big loss to lease. If there's a loss to lease and it's proven and they're actually getting those rents, there can be a huge amount of upside to NOI just from burning off that loss to lease, increasing renewals, and through better management. Same thing with concessions. Concessions loss to lease are largely the same thing, in our book. And again, on rent deltas, if the submarket's here and you're here, there's an opportunity. That's value add. And then from there, you got to drill into why is it down here and not here. And that usually pertains either to management or to physical asset. And then you go and you see, are the interiors, are they dated, old, and far inferior to what the submarket has? Then there's an opportunity to fix those. If they're the same as submarket, then maybe you don't need to do anything. You don't have to spend those dollars. And and also it's, could be functional issues as well that you could fix, or adding amenities. But so those are things that we look at when we're looking for value add.
Yeah, just to add more to that, right? The whole point, what's value add? Right? Value add, what's value add? So at the end of the day, it depends on who is going to be paying for that. So something that we see inside of the company is that, of course, we have analysis, what's the budget coming in, but it's very important to be testing. You cannot do something blindly and say, we're going to turn 20% of the units. So we believe in that turn 5, test the market, turn 5. I mean, last time that I checked, I never seen a baby running the next day. So it goes slow to move fast. Testing all the time. Everything we do has to be a Fannie Mae loan, so we're not going to be on a heavy renovation. Otherwise, Fannie Mae is going to come and let's have a talk, which is different. And the other fact that's important, going back to that 50,000 mid household income, sound like a broken record, but it's really important because you have that one. You're going to have fairly kind of proximity to good schools, you're going to have proximity to good employment, so that one have a stable neighborhood. So that's something we're always looking for. And going back to know your market, because you can see one property here, and 2 miles away there's another property. The demographic can change. So you need to look at properties separately. So what's happened that 2 miles away? Who is going to be that tenant profile? I think that's really important to have an idea. And every project that we do, right? So we still, any deal we do, we spend over $5,000 doing. Actually, we do a sewer line assessment. If anyone is bored on a Saturday night, you can watch videos of this camera going through the sewer line. That's because 7 years ago, one deal we bought was $75,000 expensive. So it's really important to know, because you're going to see value added, but we have structural issues. It's very important to understand what are structural issues that can hit you year 1, 2, 3, or 5, or so forth. Or now working to get your value, going point to Eric's point, there's something that structurally that you need to do to that property. It might cost you later. But the value at the end of the day, you create in 3 points. Management efficiency, exterior side, and inside of the units. How to put them together. That's how we see it.
Thank you, Carlos. And obviously, there's a lot of views and points on value add. And as James mentioned earlier on, value add truly is being able to sell at a higher rate than you pay for it. So, Chris, you know, as a broker, you work with a lot of different investors, a lot of different strategies, a lot of different styles. Where do you believe that investors are able to add the most value in today's market when they're looking to buy deals?
And before I answer that, I wanted to just segue back to the last question. What we've seen a lot with owners these days, and it's kind of value add on top of value add on top of value add, is all of a sudden you start seeing these apartment complexes where they'll maybe offer a bronze, a silver, a gold, a platinum unit. Same floor plan, but hey, you want, Formica countertops, you want granite, you want quartz, you want, whatever. And you can kind of see that. It's almost like, when you cut a tree down, the iterations you can see the involvement over the years of the property. So, or a classic and a premium. You can kind of see that in the language when you look at a rent roll. But to answer the question, I think what I'm seeing a lot is when I'm talking to owners and doing property tours and visiting with managers, is the most bang for the buck, at least what I'm hearing, and the owners can chime in here, is that I think they've learned from the residential side, single family homes, is if you really spruce up the kitchen, that's where you're going to get your most bang for the buck. So what's really big right now is a full backsplash, subway tile or some sort of glass stone. That it's not going to get damaged. It's going to be there a long time. The return on that is just tremendous. But if somebody goes in there and does, granite countertops, brushed nickel hardware, black on black appliances, obviously, the faux wood vinyl flooring is important. But that kitchen, more in the value add type of properties, the B and C product, it could be a single income family, and there's a lot of cooking. They don't go out much. So if you're showing that unit and you walk in and the cooker of the household, the man or the woman, really sees that kitchen is really niced up. That's a modern feel. I'm moving into a modern unit. They're willing to pay that extra, let's say $75, $100 just for that. Ignore the bathroom, ignore the living room, that kind of stuff. But that's where you see most bang for the buck. And then going on to the exteriors, I think curb appeal is most important, and how the office looks is very important. And that includes the manager, how well he or she is dressed, their presentation. That first impression is extreme. And if they feel that there's a professional operation there, they're willing to pay that extra, even though there's no extra money spent except for maybe payroll, on a higher payroll. But by far the kitchen is where, just to answer it in one word, the kitchen.
Can I jump in, because I read the question differently.
Okay, how about it?
So from the standpoint that I'm an investor, I run a fund, or maybe I'm more like in Noah's business where I'm also potentially, I'm not, but he is a lender sometimes. I don't think investors add a lot of value at all. I mean, how can we add value? By being good partners, by, showing up with the money, doing what we say we're gonna do, not bothering the great operators that we support. So I think the question, you just gotta turn the question a little bit and say, what can the operators and the managers do to create value? I just want to be clear that as investors, the best we can do is get out of the way.
I wish more investors thought that way.
What's that?
I wish more investors thought that way.
Yeah, well, they'll come around to it. Or not.
There's a point where there's a point worth noting there, and Carlos kind of touched on it earlier. There's one value add component that no one typically speaks about, and you don't see it in an Excel underwriting, and you don't talk about in these panels, but it's probably the most important value add component, which is your management group. Again, Carlos really touched on it. As today gets more competitive and there's new buyers out there, and it's important that you have a stellar management company. I mean, at the end of the day, regardless of what the numbers look like, this is a people management business. You need to make sure that your tenants are happy, or else they're going to leave and go somewhere else. So,
we got to call them residents, not tenants.
Residents. Sorry, I apologize. You have to make sure your residents are happy and they want to stay. So that trickles down from the corporate level to the management staff, to the manager. So again, that's something that no one ever focuses on, and you can't put in an Excel sheet, but make sure that you're looking internally at your own management group and making sure that you're answering residents' phone calls when it comes to maintenance, or if they have an issue with a leasing person on staff, or if they're having trouble getting their packages at a reasonable hour. Those are stuff that you have to focus on.
Thank you.
Just jump on that quickly, John. If you go back to the beginning when I said, say company culture, people and process, it's everything about people at the end of the day. That property, the heart and soul of our business is not the ownership, is that property manager and that regional manager. They're seeing people come to that office all the time. So that's the traffic. I mean, a good manager is going to break or make your deal. It's like trying to think that you're buying a company and have a CEO. Forget Uniturn. Uniturn is not the biggest expense in our industry. It's a staff turnover. Imagine have that CEO that's turning over, right? And imagine if 1 year we have 2 or 3 managers. Who is doing the execution? Boils down to that. Who the heck is delivering that one? So that's why a property manager is the heart and soul of that business. And many times, depending on the property you are, let's say in front of Hispanic neighborhood, you have this manager, and she might not have a college degree, but she's great with people. She's able to relate to them, and they come to the office. She had a good assistant manager that's talking to them, making sure to collect the rents. What's the problem for her? None. On my book, she's a leader, she's a great woman. Our support, forget Excel, how can we help? So I think that's very important that sometimes we on the, you can say the ownership on the finance side, at the property level, you understand what's happened at one. It's not, oh, we're coming on site. I mean, seriously?
Let's talk a little bit about comparing deals, analyzing deals today compared to say 1, 2, 3 years ago. Are you seeing the value component the same as in the past, or from another revenue source in today's market?
That's for me.
That's for whoever, yeah, that's for James. You want to start
Sure,
with
I can start. So just in terms of analyzing deals today versus, call it 3 years ago, I would say the unfortunate reality that we've come to accept is lower returns. Looking forward, we're expecting less than what we received in the past. I don't like to say it, but unfortunately, it's just reality. And I think a lot of that is driven on just a cautiousness on rental rate increases going forward, largely due to the second, third, fourth, fifth generation value adds that have already been put forth. Is how much more is there really left? And so we're very cautious on that. And what that leads us to do is to really focus on cash flow. Before we would be buying on very low cap rates, and I guess we still are, but trying to do less of it. And in a lot of our future cash flow that we'd be paying our investors with was predicated on rental rate increases. And we're looking at this market and seeing, unless this is a true major value add, we need to have in place cash flow. And in this market, we're assessing our deals, we're saying we're more willing to take a lower total IRR, total return, if we can be in a position where we have comfortable cash flow and very viable cash flow where we step in day one, and then we can just build off of that, as opposed to buying a dream. So we're trying to do less of buying a dream and more of buying cash flow. Anything else on that? And and just like I said, just focus on value-added concessions and true paths to value creation. For us, when we look at anything, we need to have what we say multiple paths to value creation, and that's paramount to us. We're not going to buy a deal if it's just, oh, we can upgrade those 10 units and we can create value, or those 100 units we can create value. We just say there needs to be value from management change, value from upgrading the interior, value from upgrading the exterior, and again, comps paint a very good story of this is an undervalued, under-rented asset.
Let's go ahead and jump into talk a little bit about debt structures for some of these assets, value-add deals there. So what types of debt are you seeing to be most beneficial on some of these value-add deals you're buying? And do you have any examples of any recent deal stories that you'd like to share?
Sure. So we're doing a lot of variable rate debt probably in 2015, 2016. Starting maybe late 16, early 17, we really moved more to fixed rate financing. An example, because we've seen the yield curve flatten, and at least my opinion is it will not only stay flat, but maybe get flatter, and even may invert, which could cause us, get us to a recession. But we'll go back to kind of what we're doing. So and I think that with the flattening yield curve and higher rates together, I think we have to expect longer hold periods. I think we've got to, plan for deals that we hope to turn in 3 or 4 years. I think maybe we're going to end up holding them 5, 6, 7 years on a value add strategy to buy, fix, improve, and sell. Okay, and we just did a portfolio where we did a 10-year fixed rate, but we did 5 years interest only and locked out from prepayment. But after 5 years, we've got a 1% prepayment penalty. So towards the end of that first 5 years, we could potentially do a supplemental. There's usually a period of time when you could do that, you can do it or not. But after that period of time, you've got a 1-year prepayment penalty. So that kind of is saying, look, we're not going to turn this in 2 or 3 years. We're going to hold it for 5 or 6. But after that period, we don't want to be put in a position where we have to either defease the loan or pay a large prepayment penalty. I will tell you, just if you are defeasing loans or thinking about it, paying off loans, defeasance costs are going down because of this yield curve flattening and because of higher rates. So it's a lot better time to defease a loan today than it was even just 6 months or a year ago.
Absolutely. Personally, we've had some variable loans, but we're transitioning all those into fixed rate, long term, 5, 6, 7, 8 years IL on some of the quotes we've received. I think it's beneficial with some of the changing lending markets. I think that's where we're headed. Chris, I guess what have been the most important terms of a loan that, when investors buy a deal from you, what's really, key for them when they're getting a loan?
It seems like the big question or concern or conversation piece that I have with investors as they're looking to buy a deal is what kind of loan to value can I get on this? And everybody obviously is wanting to leverage higher. But what we've seen recently, I'd say in the last 2 years or so, at least around here in the Metroplex, is that loan to value, I think just because of the price appreciation, that 80, 75, it's getting just a little tougher. So now it's 70 on some of the newer products. It's 65%. So it does remove some of the investor pool when they're a little cash strapped in the amount of equity they have. But keep in mind what we're seeing is, I'd say half, and I think everybody on the panel has touched on this, is the amount of competition on these deals has greatly increased, and the amount of those new competitors are, let's call them, fairly new, let's say post-recession. So their underwriting and aggressiveness and ideology going forward, their performance is still, painted with a little bit of wearing rosy glasses a little bit. So, they still think of, hey, I can still leverage myself very well. They also want a lot of options. I think flexibility, if they're looking to hold this, let's say 5 years or something, what can I do fixed rates versus, going even to bank debt or bridge to perm, something like that based on the condition of the property. And the conversation that doesn't come up, which is a little concerning, is, what's my exit? A lot of these people are putting on, permanent agency debt, and they're not, when they're analyzing their exit, they're not putting in, hey, can I get a supplemental? How much of a supplemental can I get? How much can I be underwrite to it? And if I got to prepay this, how bad is my prepayment going to be? And so, what's my exit cap? Things like that. So a lot of, with these, let's call them newer investors, they're not pro forming all the way until they sell this asset, which is a little concerning from a broker standpoint.
Interesting. And for me personally, I'm sorry guys, I'll jump in here. That's the first thing I think about exit, and that's why I'm very cautious, if not completely against the yield maintenance, because at the end of the day, that really puts you in a position, in my opinion, to really limit your exit strategy. So again, for us, we're looking for, I'd rather take a step down on a Fannie and long term than yield maintenance, just because it doesn't offer more options to exit out of that deal. So I think that's highly important. Sorry, go ahead.
No, the only thing I was going to add is that, yeah, the whole 75% of value, 80% of value, those days have kind of come and gone as well. Now everything is cash flow constrained, and with the increase in rates, the 10-year treasury, from Q4 to Q1, it's basically gone from low 2.4 or more or so to about 2.9, a little bit less. And if you do any kind of calculations on loan sizing, it equates to about a 5% decrease in loan size just based on that treasury cost. And again, it depends on who the lender and spreads and whatnot, but it's a real decrease, and I think that's something that's going to impact these markets in the first half of this year, unless the 10-year retreats a little bit. And then for us, just in terms of what we do, we prize flexibility and optionality over anything else. So if you look at our portfolio, we are 100% floating rate, which means we can sell any deal in our portfolio tomorrow. And that is something that we prize over anything else, is the ability to do that. We hate looking at deals that have an assumption and potential for supplemental, because it's not the way you want it to be. It's not your structure, it's their structure. And sometimes it's better, but ultimately, if we wanted to put a bridge loan on because we wanted to do a value add program that we think that we could take that asset to the next level, all of a sudden we can't necessarily do that unless we put on some sort of a really expensive, preferred or mezzanine piece, and then all of a sudden the deal economics get that much worse. So for us, all floating.
Yeah, and everyone's kind of talking about the one key point, which is leverages have dropped slightly. I think there's obviously a lot of debt structures out there that we're all aware of. I've had a lot of experience in preferred equity, and I know some people really love it and some people don't like it, but just so everyone has an understanding of what it is and how it can help you leverage up the capital stack. Imagine you're buying an asset and you're getting an agency loan or a bank loan at roughly 75%. So you still have to come in with the additional capital to buy that asset. What we're able to do through preferred equity is we come in, we put in about half of the total equity, so we'll leverage you up to figure somewhere in the 85 to 90% of the deal, but we're a non-participating partner. So unlike a JV partner where there's waterfalls and hurdles and promotes, we get none of that. We basically get a fixed coupon, just like a debt piece, and allow you to leverage up your own deal and keep your upside. So if you go in and do a value add plan and push the NOI 20%, 30%, 40% over a couple of years and then sell the asset, you just pay us back basically our principal and our agreed to coupon, and then everything else stays in your pocket. So a lot of investors who have a value add component have decided to use preferred equity as a way to keep more of their own deal while leveraging it up.
Very good.
No, for us, very boring. Fannie Mae only fix. There's a saying, I want to sleep well at night. I think that's an obligation that we have to our investors. That's how we look, trying to be as conservative. And we say in the office all the time, how can you beat that budget, trying to get higher yield. So it just being conservative. I think that's something can be said. Right? Or what's the rule number one? Don't lose money. Rule number two, this is rule number one. So that's how we operate.
It just shows, obviously, we have multiple different strategies here on the board. what's best for you, what's best for you. Variable versus locked, fixed. I mean, everybody does it the way they're comfortable with, and that's the beauty of all the lending options we have available. Let's just go ahead and touch a little bit on managing to achieve higher yields. And Carlos, you kind of already touched on this. You really talked about the culture and your staff, and really that's the key to your success. Are there any certain fundamentals that you're implementing with regards to your staff to help increase yield in today's market? What are the things you guys are really looking at where you can really capture yield on some of your current assets?
Yeah, that's actually that's my favorite subject. When you start getting out of the multifamily, we're going to talk about people. It's the heart and soul. It's all about the execution. At the end of the day, let's look at the engine, right? You open it and look at the car, and who are the people behind the scenes? So I'm very thankful for the people that we have. I think that, we're all talking about finding deals, how hard it is. Can I tell you how hard it is to find one person to join the company? So the last person who joined was 403 resumes to find one guy. But it's amazing the quality of the people, because how can you find these right people that they actually care? Their opinion inside of the company, they want to listen to. It's not because, oh, we are there. So I think that's important when you see where you want to take this business, and if you're people that we have in your organization. I think that there's a lot of training that you do inside of personal assessment, inside of trust, and putting that one. Because once you look at the execution, it's much more predictable. The questions these people are bringing to us, many times in my partner's term, we'll look at each other and say, that's amazing. Wow, this guy, how does this question every single one in the process? So to me, that's the biggest value add in our industry, is that taking the time to hire the right people, to give them support, create a culture inside of the company that you have enough trust that you on our side can be challenged, because trust is the foundation of everything. So I can get into more details, and then, like we were talking yesterday, right? If we were to look at our average rent growth in our portfolio last year was 6.4%, our lowest one being 3.8, and the highest one 11.5. Why? People.
The only thing I would add to that is the one piece of technological advancement over the last 10 years or whatever it is that I think has been really, really important to management is online ratings. I would say at this point, in this day and age, we have far more insight into what's actually happening on our properties than we ever have. And I can't remember who mentioned it, but someone said that, a lot of times managers will not want to tell you when there's a problem. As much as you say, tell us, there's a hesitation, there's reluctance to deliver bad news. And so a lot of times we have to find out about things through online reviews, but at least we have that insight into what's happening. We say, oh, we got a plumbing issue. How did we find out about that? Because we got a 1-star review last night. What's this about? How come you didn't call us? And so now it's almost forced our management teams to be more forthright with us in the issues that they're facing, because they know that if they don't report it, we're going to find out because we look at the reviews at least on a weekly basis. And I think that it's of critical importance, and it's going to it gives tenants a voice, but it also forces us to be better at our jobs and gives us more insight to the actual physical problems that our sites have.
Very good. Let's talk a little bit about discussing some strategies with regards to managing operational costs. James, I know you spoke. Do you want to jump in on this a little bit?
Sure. I'd say the single most important thing for managing costs is be on site and understand your properties. And just like Carlos said, you can't hide behind your spreadsheets, even though it's really easy to do so. And you got to talk to vendors, you got to talk to contractors, you got to be a presence, and you have to be on site and understand exactly what is going on and get to know the vendors, work with the pricing, and again, just be on site. That's the most important thing, because it's very easy for your on-site management teams to pay more. It's always easy to pay more. They have to work to pay less. And if you're not there constantly pushing on them, then your costs can get away from you. And we always say it's a full-time job to manage costs, and it really is, because it's easy for them to get away from you, and you have to be paying attention. What we do is we take our expenses, we sort them high to low, and we walk through with the on-site team on a very regular basis and say, okay, how do we chip away at this one? How do we chip away at this one? How do we chip away at this one? And again, I don't have any great wisdom here other than just pay attention and be there. And that's what we try to do. And also track your historic data. Look at what you spent in the past and the growth rates for each individual line items, and spend a lot of time focused on the data.
For us, cost is one of those, I would say, probably one of the most important factors. We talked earlier about value add. Really, for our program, the way we run, we really look at expenses, and that's really where we find a lot of those value add in the deals we buy. Our partner Lance, who sits in the back, runs our management company, and every deal that we have, we know exactly what it's going to cost to turn a unit, whether it's a hard turn, soft turn. We use the same vendors, same appliances. We get everything the same. So across the board on every single property, you know exactly what that cost is going to be. And what it turns out does is it keeps the managers accountable. We can walk into a unit and say, okay, this is going to cost X amount of dollars. We're also going to look at that and say, okay, here's our vacancies. It stands on our budget for this month. It's addressed based on demand and cost, which units we're going to renovate first. And then we'll push the other ones down the road next month. That way it enables us to stay on the budget, but still able to turn units at a reasonable amount. So for us, that's really been a key factor as far as managing costs, is really being on site, as James talked about, but knowing exactly what that cost is going to be. If we feel the cost is not in line with the market, we're going to go out and shop it. And we're going to keep our people in line by doing that. I'm not, other than my wife, I'm not married to anybody. So if I need to change, I'll change. So let's just jump in. We're running out of time here. Let's talk about the future. 2018, 2019 will be continued demand in commercial real estate with the level of uncertainty in the market cause a pullback. Obviously, we've seen a little bit. Lenders leverage, as we talked about, is not as aggressive as it used to be. How do you protect your investment in the event that the cycle comes to an end? Anybody?
Well, I like the people idea. I think that's important. I think just lining up with the right people. But at the end of the day, if you're generating cash flow and you're not having to write a check to keep your property, then you're going to survive. So if you do underwrite a deal, make sure it has a lot of cash flow going in, or either going in or shortly after fixing it. Because if you underwrite it and say, okay, I'm going to accept a 4 or 5% yield, and if you go to San Francisco or Boston, they like 3s and 4s. I mean, it's crazy. But it's not going to take a lot. You have no margin of error if you accept a small yield. So we're talking about maximizing yield. Maximizing yield isn't just a, let's all make money investment strategy. It's also a let's not lose money strategy. Because if you maximize yield going in, then you have a bigger buffer.
Very good.
No. Go ahead. Oh, I just had a quick comment. Just given the sheer amount of capital that's been raised to invest in these assets that needs to be deployed, I think that's going to be driving demand. That's going to be maintaining asset prices, and people still need a place to live. And I don't see any major red flags that's going to be a major drag on the economy anytime soon. So as far as we're concerned, we'll be buying into the next year, 2 years, and soon we can find deals. But we're not terribly concerned. And maybe that's a problem, but.
Close your eyes.
At the end of the day, good
Sell to
operator.
James.
At the end of the day, good operator is a good operator. Poor operator is a poor operator. You're going to make of it what you make of it. And there are people that thrive in 9 and 10. So at the end of the day, if there is a shift in the market, there will be opportunities. People that will not do so well, but that's just part of it. I guess we'll go ahead and just open up to questions on anything, and we can go from there. We can leave until one person asks a question, so. That's fair.
So my question, you guys talked about kind of going in cap rates and the compression on that. What are you guys performing for exit caps if you're, maybe the long term? What is your cap and a short term bulk guy? What is your exit cap strategy? With interest rates rising, what do you guys see that happening?
I mean, on most deals, we're underwriting exit rate caps at 50 to 75 basis points higher than going in.
I'd say about the same for us.
I agree.
And is that going in underwriting based, like James was saying before, on your pro forma cap rate or on your entry cap rate?
Usually how we look at it is T12 with a tax adjustment.
Somebody else's T12
Someone else's the current T12 with the new tax amount.
and insurance.
If we believe it's going to be a large increase, For example, Houston, where we saw 30%, we will adjust it. If it's another market, let's say Wichita, that hasn't been hit, we'll leave the insurance the same.
They have tornadoes in Anybody else? All right, well, I want to thank everybody on the panel today for being part of this. It's a lot of fun. Thank you again. Appreciate spending my time.